P2P lending today is what the high interest savings account was a decade ago. 5 to 6% interest returns on your deposited cash, actual cash in hand returns instead of pennies.
The only difference is that savers must now become investors and take on some risk. You are lending to people and businesses after all, and some may go bust. But some of the platforms and services like Orca seek to minimise this risk as much as possible.
It is simply a fact that in the modern age of historically low interest rates, to win in life, some risk must now be taken to achieve those life-changing returns. But is there a best way to invest in peer-to-peer lending? Let's check it out.
Welcome to Unshackled.com, the investment channel and website that says you and your finance is free. This is Andy, I'm Ben, and if you like what we say, hit the like button and click subscribe.
Also, check out the Unshackled.com website where we've added a 4-step guide to stock market investing that you can download for free, along with the sign-up bonus referrals mentioned later in the video. The link is in the description below. Let's get into the video.
Avoid the large returns. Counterintuitive? Not at all. There are some peer-to-peer platforms out there that advertise returns of 20% or more. What they don't advertise is that such high returns on a zero effort investment means risk must be sky high. 20% of nothing is a 0% return. These tend to be investing in single projects that may or may not succeed.
Think about it. A peer-to-peer platform is a middleman for two parties, a borrower and an investor, also known as the lender. The other side, the borrower, must therefore be willing to pay at least 20% interest on their loans, whereas the banks, who typically lend around 7%, have probably deemed them to be uncreditworthy.
Focus on business and personal loans. A lot of peer-to-peer platforms deal specifically in new build commercial property projects, of the type that tend to be left part finished or made into car parks when a recession hits. Whereas the peer-to-peer platforms that we use tend to lend to small and medium-sized businesses with loans split across hundreds of borrowers.
Diversified by business activity, by amount and by project, this type of loan portfolio will include some businesses that invest in property anyway, but these will be a smaller and diversified part of a wider portfolio.
Stick to the big names. Sticking with the big established players in the market is in our view a sensible move. RateSetter and Funding Circle are to the peer-to-peer world what HSBC and Lloyds are to the banking world. Big established platforms that are good at what they do. There are maybe 10 really good peer-to-peer platforms that we would rate as having a professional service combined with a decent 5 to 6% return, most of which we hold significant deposits in. They are always evolving and trying to find new ways to improve their services and rates. But of these 3 are our current favourites.
RateSetter, giving you a choice of rates of around 4 to 5.5%, depending on whether you need instant access or don't mind locking your money away for a period of time. They also give you the flexibility of choosing your own rate, which gives you greater control over your finances. RateSetter has a £100 sign-up bonus for new users when you invest £1,000, so an immediate 10% boost to your returns in year 1. RateSetter also has a provision fund to protect users from defaults on loans, on the rare occasion that one of its carefully vetted borrowers goes bust.
To date, nobody has lost any money on RateSetter to bad debts due to this provision fund. It has a 100% success rate over 9 years. People haven't even lost a penny. We feel that our money is in safe hands with these guys, though of course there is always some small risk of future losses.
Which is why we wouldn't put all of our eggs in one basket. Assets Capital. Another great platform, Assets Capital offers an interest rate of 6.25% on its Great British Business account. It also gives you a £50 sign-up bonus if you invest £1,000 with our link. So another 5% boost in year 1. All of these offers can be found on the Money Unshackled website, which is linked to below. Remember, on these decent platforms, your investments get spread across many loan parts, so they get spread across many businesses, diversifying away the risk. Some of these businesses that are being lent to will go bust and therefore will default on their loans, but these typically represent a sub 1% hit to your returns.
The last 7 years have seen Assets Capital evolve from 10% borrowing rates with 5% defaults to much lower 7% rates and 0.1% defaults over the last 3 years. They've clearly de-risked the portfolio as they've grown and are being more selective about the businesses that they accept as borrowers. We can testify that in the last couple of years, we have been receiving the target return.
Lending Works. Another sign-up bonus, £50 for £1,000 invested, another big interest rate of 6.5%. That's Lending Works. Again, with a provision fund to protect your losses called the Shield. Lending Works make a big deal about their provision fund, their Shield, on their website. It has resulted in every payment of capital and interest being paid back to their investors on time since they launched in 2014.
Once you have built yourself some cover with an emergency fund, why would anybody leave the rest of their money sat languishing in a bank savings account? 0.1% return? No thanks, we'll be using Lending Works, Assets Capital and Rate Setter.
Minimise your platform risk. The reason we started investing in multiple peer-to-peer lending platforms, aside from the multiple sign-up bonuses, was to massively dilute our risk without sacrificing returns. You could just invest in Assets Capital and earn 6.25% and achieve diversification across hundreds of businesses, but what happens in the unlikely event that Assets Capital goes bust?
This is called platform risk, and the way to mitigate it is to use multiple platforms. The risk of one of these platforms going bust without a contingency plan is small, but why take the risk in the first place when we're talking about thousands of pounds? You could invest £3,000 across the platforms mentioned earlier, £1,000 into each, and if one did collapse during a nasty recession, only a third of your pot is in risk.
Orca is a cross-platform service that seeks to tackle the platform risk on your behalf, but is it any good? Let's take a look at Orca now. Orca. Orca is a platform of platforms, or to put it another way, when you invest your money in Orca, it actually distributes your money to multiple platforms on your behalf.
This is a fantastic innovation, but still falls short of the best way to invest in peer-to-peer platforms in our opinion. The most diversified offering requires a minimum investment of £7,000, which spreads your investment across 4 platforms. We're actually annoyed that these are the only platforms on offer because Orca has some great potential. There's no Rate Setter, no Funding Circle, no Lending Works, but we're sure there used to be.
If you invest less than £7,000, you get less diversification. £3,000 diversifies across just 2 platforms, most of which is in Assets Capital, which we love, and the rest in Landbay, which we're sceptical of, as it's a higher risk property investment platform.
It's the same mix when you invest £1,000. For £1,000 you are probably best off just picking one platform and diversifying automatically across hundreds of businesses, rather than sticking £300 of that 1,000 into Landbay and scooping up a sign-up bonus by going direct. Though we should say that Orca do have a sign-up bonus for new customers. We'll put a link to this on the Money Unshackled website, so be sure to check that out. If you can be bothered with the administration of having multiple accounts, and if you have more than £2,000 to invest, then why not just open 2 or more platforms and invest with them directly for better diversification across purely business assets. One positive thing about Orca is that you can invest all of your peer-to-peer money into an ISA. It is not possible to do this by going direct across multiple platforms because you're only allowed to have 1 ISA per tax year, and therefore you could only open 1 ISA on 1 platform.
Double fees. Finally, diversifying your P2P investments through a third-party platform like Orca results in a double layer of fees. You are already paying fees on the individual platforms, but then you have to pay the Orca fee on top.
It may be worth it for the all-in-one approach, though it is not our preference to pay extra fees unnecessarily.
We appreciate what Orca is trying to do by addressing platform risk, but you can just go direct and open accounts with your favourite platforms.
Best way to invest in peer-to-peer lending. Diversify across multiple platforms to limit your risk and scoop up all of those juicy sign-up bonuses in the process. As well as those free platforms that we mentioned earlier, we also invest funds into Zopa, Funding Circle, Growth Street and Lending Crowd, most of which also have sign-up bonuses. Check these out on moneyunshackled.com. Don't keep your money wasted in a bank. Get it working for you.
Question of the day: how much do you have invested in peer-to-peer lending, and do you use any of the big platforms mentioned on this video, or do you use any other platform? Let us know in the comment section. Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. If you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.